Bitcoin is about to close its worst quarter. Since 2018, with 2 days left in March, Bitcoin is trading at $66,750 as of March 29, 2026, down roughly 26% from its January 1st open near $90,000. If the quarter closes here or lower, it will mark Bitcoin's worst first quarter since 2018, when BTC fell 50.5% during the depths of the post-ICO crash. The decline extends a streak that began at Bitcoin's all-time high of $126,000 in October 2025. 5 consecutive monthly red candles later, BTC has shed nearly half its value with no sustained recovery in sight. 5 red months and counting. The quarterly loss is the product of 3 individually punishing months. January dropped 10.17%. February fell 14.94%, the worst February in Bitcoin's recorded history against a long-term average of plus 11.11%. March briefly offered relief, with a bounce to 76,013 around mid-month, but that rally has since unwound entirely. At 66,715, March is on pace to close roughly 3 to 4% lower, meaning all 3 months of Q1 would individually finish in the red. According to data from Currency Rush, Bitcoin has posted negative Q1 returns in 6 of the last 13 years: 2014, 2015, 2016, 2018, 2020, 2022, but the severity of this decline at 26% ranks it 4th worst behind only 2018, 55%, 2014, 37.7%, and 2015, 21.4%. The 5-month losing streak from the all-time high is itself unusual. Amber data noted that 3 consecutive red months near record highs have been rare historically, and FEMEX data shows that back-to-back negative months opening a year have only occurred 4 times since 2013. The ETF drain spot, Bitcoin, ETFs, once the primary demand engine behind 2024 and early 2025's rally, have reversed course. According to Amber data, $6 to $18 billion has drained from spot Bitcoin ETFs since November 2025. The worst single day came on January 29th, when $817 to $87 million left in a single session. ETF assets under management fell below $100 billion by early February, down from over $150 billion at the October peak. A brief reversal on February 9th to 10 produced back-to-back inflow days for the first time in a month, but it proved temporary. The bleeding has continued into late March. Ethereum ETFs are faring worse. As of this week, spot ETH funds are on an 8-day consecutive outflow streak, with ETH itself barely clinging to the $2,000 level. Structural damage under the surface. The headline price decline understates the structural deterioration. Open interest in Bitcoin futures collapsed 58% from a peak of $56.6 billion to $23.6 billion. Order book depth at the 10 basis point level fell 65%, from $38 million in September to $14 million by February, meaning the market has far less capacity to absorb large orders without moving price. The basis trade, a once popular arbitrage between spot and futures, compressed from over 15% annualized to 2.4% below the risk-free rate. That compression removes a key incentive for institutional market makers to participate, further thinning liquidity. On-chain data tells a similar story. Nearly half of all circulating Bitcoin is now held at a loss, according to Amber data. Stablecoin supply recorded its first monthly contraction in 14 months, suggesting that sidelined capital is not waiting to buy the dip, but leaving crypto markets entirely. Where the fear sits, the Fear and Greed Index reads 25 as of March 29th, firmly in fear territory. It has not touched greed since early October 2025, the longest sustained fear reading since the 2022 bear market. Bitcoin dropped below $67,000 earlier this week on $300 million long liquidations. The $14 billion options expiry that hit on March 28th had a max pain at $75,000, well above the current spot price, suggesting that derivatives positioning was still too optimistic heading into expiry. Historical playbook after bad Q1s. The Q1 2018 parallel is instructive, but not encouraging on a short time frame. After falling 50.5% in that first quarter, Bitcoin continued lower for another 9 months, bottoming at $3,200 in December 2018. The 2014 comparison, 37.7% Q1, followed a similar pattern. BTC did not recover its January 1st opening price for more than 2 years. However, data from Currency Rush shows that Q2 has delivered the opposite direction of Q1 in 8 of the last 13 years. If history rhymes, Q2 may offer some relief. But the structural damage, particularly the ETF drain, basis trade collapse, and thinning order books, means any recovery will require new demand, not just a sentiment shift. Strategy now holds 76% of all corporate Bitcoin, a concentration that has itself become a risk factor. If Strategy faces margin pressure or needs to raise capital, forced selling could accelerate the decline further.